All right, let's get right into it. Whether you call yourself an investor or a trader, you're here for the same reason, right? To grow your money. But the way you get there, well, those paths could not be more different. So let's break this down.
So, investor or trader? What really is the difference? And look, this might seem like a simple question, but trust me, the answer changes everything. It shapes your strategy, your mindset, the risks you take, even how much you pay in taxes. Picking your path really starts with getting this one core distinction right.
When you boil it all down, it kind of comes down to this. An investor is buying a piece of a business. They believe in what that company is doing long term. They're thinking in years, maybe even decades. A trader, they're buying and selling stocks almost like tokens to profit from price swings. They're often thinking in days, hours, sometimes even just minutes.
And that right there, that's the single most important factor that splits these two worlds wide open. The time horizon. Seriously, how long you plan to hold something is the fork in the road. It dictates basically every single decision you're going to make from here on out. Okay, so let's walk down that first path, what I like to call the investor's marathon. This is a game of patience. The whole strategy is about letting the incredible power of compounding do all the heavy lifting for you over a long, long time. And this quote, man, it just nails the whole investor mindset, doesn't it? It's not about trying to be a genius who jumps in and out at the perfect second. Nope. It's about being in the market, riding the waves. The biggest danger isn't that the market will crash, it's that you'll panic and sell at the absolute worst time. So what does this look like in practice? Well, an investor's main goal is that slow, steady buildup of wealth for big things, like retirement. We're talking a time frame of at least 5 years, usually way more. Their main weapon against risk is diversification. And here's the kicker. It's a mostly passive game that demands patience above pretty much everything else. So, what's their main tool for the job? It's something called fundamental analysis. Think of it like being a company detective. An investor is digging through financial reports, checking out the company's health, its earnings, what's happening in the industry, all to figure out what the company is really worth deep down. They're looking for businesses that are built to last. Okay, now let's flip the coin completely. On the other side of the spectrum, you've got the trader sprint. This path is all about speed, precision, and being constantly plugged into the market. And just look at these time horizons. I mean, we are in a totally different universe here. A scalper might hold a trade for just a few seconds. A day trader makes sure they're all done before the closing bell rings. This world moves at a pace that is just fundamentally different from that slow and steady investor marathon. And the trader's tool of choice? It's called technical analysis. So instead of being a company detective, a trader is more like a market chartist. They're staring at charts, looking for patterns in past price movements. The core belief here is that all the important information is already baked into the price. Their whole job is to find that perfect moment to get in and the perfect moment to get out. And wow, does it get detailed. A lot of serious traders use this multi-time frame approach. They'll start way out on a weekly chart just to get the big picture trend. Then they zoom in to the daily chart, then the 4-hour chart. And finally, they might be using a 15-minute chart just to nail their entry with surgical precision. It's an incredibly demanding process. Okay, so all that intensity, it brings us to a really critical point. There are these hidden rules of engagement for trading, and they create some pretty big hurdles. Honestly, it's a much, much harder game than it looks from the outside. Let's just start with one number. That's it, $25,000. For a lot of people who want to trade actively in the US, this is basically the ticket price just to get in the door. Why that number? Well, it's because of something called the pattern day trader rule. It's a regulation that's really designed to protect newer traders from blowing themselves up. Basically, if you make 4 or more day trades in a 5-day window, you get slapped with this PDT label. And then you have to keep at least 25 grand in your account at all times. If you dip below that, you're locked out of day trading. This rule alone separates the curious from the committed. And this table just lays it all out, side by side. Investors can get started with almost nothing. Active traders, they need that $25,000 minimum. Traders also get access to more buying power, which is just a fancy way of saying they can borrow more money to make bigger bets. But that's a double-edged sword. It means their main risk tool isn't time. It's a cold, hard mathematical rule. Never, ever risk more than 1 or 2% of your capital on any single trade. Oh, and then there's the tax man.
This is a huge, often overlooked gut punch for traders. See, an investor who holds for over a year gets taxed at these really nice long-term rates, 0 to 20%. But a trader's profits, they're short-term, and they get taxed as regular income at much higher rates, sometimes all the way up to 37%. That makes it way harder to grow your money. And maybe the biggest hurdle of all, it's the battle that's fought right up here, in your head. The speed and the high stakes make traders fall into all these mental traps, like revenge trading to win back money they just lost, or getting way too cocky after a lucky streak. So the most important thing for a trader's survival isn't their strategy, it's just rock-solid, unshakable emotional discipline.
So you might be thinking, wow, okay, so I have to pick one or the other? Well, not exactly. For people who want that long-term stability, but also kind of want to play that more tactical game, there's a really smart strategy that blends the best of both worlds. It's called the hybrid approach. Here's how it works, and it's actually pretty brilliant. You build this big, stable core of long-term investments, your marathon portfolio. Then you carve out a much smaller, totally separate pot of money for your active trading. You ring-fence it. That way, your main nest egg is safe, and any of the high-risk trading you do is with a set amount of money you're prepared to lose. So what might that look like? You could have something like this, maybe a solid 60% in your core, long-term stuff, 30% set aside for your active trading ideas, and a nice 10% cash cushion for safety or jumping on new opportunities. It's all about creating a smart balance. Which brings us all the way back to the big question. Now that you've seen both sides of the coin, the long, patient marathon and the fast, intense sprint, which path really fits with your life? The right answer depends completely on you. You got to ask yourself some honest questions. What are your goals? Are you trying to retire in 30 years or generate some income right now? How much time can you realistically give to this every day? And be honest with yourself. What's your actual tolerance for taking a loss? Do you have the cash and, more importantly, the extreme emotional control that trading demands? Because at the end of the day, there is no better path. There's only the path that's better for you, for your goals, for your bank account, and for your personality. So the real question I want to leave you with is this. Which of these two worlds is truly built for you?